When a company needs cash, it has three options. It can borrow it, raise it, or earn it. In this lesson, we're going to focus on one of the ways that companies can borrow money or capital, and that's by issuing bonds. Here's something I want you to hold on to from the very beginning. Accounting for debt is accounting for debt. Whether it's packaged as a bond, a note, or a lease, we treat it essentially the same way. So if you really understand bonds, you'll find that the mechanics will pop up again and again when accounting for debt. Before we get into the mechanics of bonds, though, let's review the concept of financing. Say you want to start a business, or maybe you already have a business and you're interested in expanding your existing operation. Either way, you're going to need some cash. Aside from earning it, what are your options for getting the capital that you need? The most obvious option is to head straight to the bank and borrow it. We just have to pay it back with interest. We call this debt financing. Another option is to find an investor. In exchange for their capital investment, we give them a percentage of our company. We don't have to pay them back, but they're now a part owner in our business. We call this equity financing. Although bonds fall solidly in the debt financing category, they blend some of the characteristics of both. We're going to borrow the capital, but instead of going to the bank, we're going to borrow from investors. Let's consider another scenario. This time I want you to imagine a very big corporation that needs to borrow a very large amount of money, hundreds of millions of dollars. It could walk into a bank and ask for the whole thing, but finding a single lender willing and able to loan that much at a reasonable rate is hard, maybe impossible. So instead, the company borrows from the crowd. It breaks that giant loan into thousands of small, identical pieces, usually $1,000 units, and then sells them to investors all over the market. Each of those pieces is one bond. If you buy one, you've lent the company $1,000, and in exchange, it promises to pay you interest every 6 months and then return your $1,000 at maturity. So a bond issue is really just one big loan chopped into bite-sized pieces that can then be sold to investors. And notice there are two different interest rates lurking here, which we'll separate in a minute, but there's the rate printed or stated in the bond contract, and then there's the rate that the market is actually demanding. Keeping those two straight is the key to this entire concept, so let's slow down and look at them. I want to emphasize the wording here because it can be confusing. If a company sells or issues a bond, sell and issue mean the same thing in this case. They are selling a promise. In fact, they're selling a set of promises. The company promises to pay bondholders a fixed amount of interest every 6 months, and it also promises to pay back the amount that they borrowed, or the face amount of the bond, at a specific maturity date down the road. That's two promises, a stream of interest checks plus a single payoff at the end. So if a bond is just a bundle of future payments, then the price of a bond is simply what those future payments are worth to you today. And we already know how to answer that question. It's a present value. That's the entire secret of bond pricing. A bond's price is the present value of its two promises. Now let's get back to those two rates. There are two, and they do two completely different jobs. The first is the stated rate. You'll also hear it called the coupon rate or the nominal rate. They all mean the same thing. This rate is what's printed on the bond contract, the piece of paper that the company is actually selling. And it never changes for the life of the bond. Its only job is to set the cash interest amount. You take the face amount of the bond, multiply it by the stated rate, and then multiply by the fraction of the year. And that's the cash that the company actually pays every interest period. If a bond has a face of $1,000 and a stated rate of 10% paid semi-annually, the company pays $50 in cash every 6 months, always. That number is locked in. The second rate is the market rate, also called the effective rate or the yield. This is the rate investors are demanding right now for a bond of the similar risk and maturity. It floats, it changes, and it reflects the economy and the riskiness of the borrower. And here's the crucial part. The market rate does not touch the cash interest payment. Instead, the market rate is the rate we use to discount the cash flows. The market rate sets the price. So say it with me. The stated rate sets the cash, and the market rate sets the price. If you can keep those straight, you'll be way less likely to get confused about discounts and premiums later down the road. So remember, one sets the cash, the other sets the price. Now let's actually get into pricing. Remember, a bond promises two different kinds of cash flow, and we discount each of them. The first cash flow is the interest. Those equal semi-annual interest payments form an annuity, the same fixed amount period after period. So we discount them using the present value of an ordinary annuity factor. The second cash flow is the principal, the single face amount paid once at maturity. That's a lump sum, so we discount it using the present value of a single sum factor. And this is important. We're going to discount the bond using the market rate. Remember, not the stated rate, the market rate. The price of the bond is the present value of the interest annuity plus the present value of the face amount both discounted at the market rate. Add those two pieces together and you have the issue price. That's the whole formula, and we're going to use it every single bond problem. Price equals present value of the interest plus present value of the principal discounted at the market rate. There's one mechanical trap that catches students every term that's worth mentioning before we actually work through a problem. Bonds almost always pay interest semi-annually. That means before you discount anything, you have to convert everything to a semi-annual basis. 3 little adjustments. First, the rate. Cut the rate in half, both the stated rate and the market rates, because each period is only half a year. A 12% market rate becomes 6% per period. Second, the number of periods. Double it. A 10-year bond doesn't have 10 interest periods, it has 20. Third, the cash interest. It's the face amount times the semi-annual stated rate. So a 10% bond actually pays 5% of face every 6 months. Get in the habit of doing those 3 conversions first before you touch a present value table or calculation. Have the rate, double the periods, and compute the semi-annual cash payment. Students who skip this step are usually the ones who get the bond pricing wrong, so try to make it automatic. Now let's work through an actual example. We're going to price the very same bond 3 different times, changing only one thing, the market rate. First, we'll set the market rate above the stated rate, then exactly equal to it, and then below it. We'll watch what happens to the price each time. It'll drop below face, then land right on face, and then rise above face. Now we're going to actually price a bond. We're going to use Excel because it allows us to do the present value calculation in the spreadsheet rather than using the factor tables, which is also an option available to you. We've got a bond issued on January 1st here, and it is a $1,500 bond, meaning I am selling a piece of paper that says, if you give me $1,500, I promise to pay you back. I also am promising a stated interest payment, a stated rate of 8%. So I'm going to make 8% payments for 3 years. It's a semi-annual bond, so I'm going to make those payments every 6 months for 3 years. At the end of the 3 years, I'll pay you back your $1,500. So the question is, because the market rate is 12%, it's not 8%, then what can I actually sell that bond for? So I'm going to use the rates given to me here. And remember, I have to have all of the rates and double the periods because it's semi-annual. So the market rate is what we're using to calculate the discounting. I'm going to take the 12% and divide it by 2. The market rate helps us calculate the present value. The number of periods is 3. And we're going to multiply that by 2 because we're actually making 6 interest payments over the course of this 3 years. Now I need to calculate the payment. And what I'm going to do is take the face value of the bond and multiply it by the stated rate. The contract says I'm promising to make 8% payments for 3 years. So I need to use the 8%, the stated rate, when I calculate this payment. It never changes. I do need to have this rate. So I'm going to take 8%. And I'm going to divide it by 2. I'm also going to make this payment negative in my calculations. I'm going to put a negative sign in front of that because it'll make my present value calculation positive. I'll use negatives anytime I'm putting in a number that represents a payment I'm making. So that is a negative 60, and then I'm also going to put in a negative 1,500 for the future value. That's what I have to repay in the future. All right, so now I can do my present value calculation, and I'll do equals PV, parenthesis, and reference all of the correct numbers according to the formula that pops up here. So 6% is my market rate divided by 2. My number of periods is my 3 years, but multiplied by 2. Then I've calculated my payment as $60, and I've also calculated my final payment of a single amount, which is $1,500. And then I'll close the parenthesis. And what I'm doing here is doing the present value calculation of both promises at the same time. I'm taking the present value of the annuity, the interest payment, and the present value of the single amount that I'm going to pay back in 3 years of $1,500. And I get $1,352. This is what I can actually sell this bond for. Now let's look at the same bond, except different circumstances. The only thing we're changing is the market rate. So now the market rate is 8%. It's the same exact rate as the one that's stated on our bond. And let's see what happens. So I'll put the market rate here in my calculation, but I do need to divide it by 2 because it's semi-annual. Remember, I always use the market rate in my present value calculation. I'm discounting back to the present my promises that I'm making at the market rate. The number of periods is 3 times 2. And my payment, which I'm going to make negative, is 1,500 times the stated rate divided by 2. And then finally, I need my present value of the future amount that I'm going to pay back, which is $1,500. I'll also make it negative since it'll be a payment. Enter the present value calculation, reference here the rate, the number of periods, the payment, as well as the future payment of the principal. So the interest payment and then the future payment of the principal, calculating both promises at one time. $1,500. So you'll notice the present value of this bond, what I can sell it for, is actually the same as the face value because the market rate equals the stated rate. All right, last example, we're going to do the same exact bond, except notice this time the market rate is less than the stated rate. So the market is demanding a rate of interest that's actually lower than what we're paying. So we're likely able to sell this bond for more than its face amount. So let's take a look. First, I'm going to reference the market rate here in my present value calculation, but I need to have that 2, divide by 2. The number of periods is 3 times 2. And then I'll calculate my payment. I'm going to make that negative. It's going to be 1,500 times the stated rate, halved, divide by 2. Finally, I have the promise to pay back the $1,500 at the end of the 3 years. I'll make that negative. And now I can do my present value calculation. So equals PV, and I'll reference my rate, market rate, the number of periods, the interest payment, my first promise, and the future payment of $1,500, my second promise. And notice that the price of this bond, the present value of those two promises, is actually higher than the stated face value of the bond. Now it's $1,540 is what I can actually sell the bond for and what I can actually borrow. All right, let's lock in the foundation. A bond is a promise, 2 promises actually. Fixed interest payments, usually every 6 months, plus the promise to pay back the face amount of the bond at maturity, what we borrowed. The promises are determined by what is printed in the contract. How much the bondholder will receive in interest is determined by a stated rate. No matter what happens with the market rate, this payment never changes. The amount that bondholders are paid back at the end also never changes. It's the face value of the bond printed in the contract. Market rates, however, fluctuate regularly, daily even, and this determines what we can actually sell the bond for. It sets the price. To determine the price, we just calculate the present value of the 2 promises using the market rate. And don't forget to pay attention to whether interest payments are made semi-annually, because you'll need to have the rate and double the periods before you discount. Next, we'll work on allocating interest expense for bonds that are issued at different market rates.